Hey, everybody. I am joined by one of my favorite financial writers, Dan Caplinger. He's been writing for The Motley Fool a lot longer than I have. I learned a lot from him, so I'm really excited to have him here. We're going to talk about a bank stock that we kind of disagree on, one that I sold and that he just recently bought. Before we dive in, check out the link you see on your screen, fool.com/Frankel. Get the top 10 stocks to buy from The Motley Fool. It's the best way to support this work we're doing on YouTube. Again, that is fool.com/Frankel. So the stock in question, I won't keep you in suspense, is Goldman Sachs. Ticker symbol is GS. And this is one that I sold, but I'll put an asterisk on it. I sold it in December 2023. And there's a few reasons I sold, but this was a COVID investment for me. In other words, I bought shares at the depth of the COVID crash because they were so irrational. And for me, it was still like a double at the time. And it's one of the cases where a reason I bought the stock no longer applied. I loved Goldman for its consumer banking potential when I first bought it. The Marcus platform had shown a lot of early success. Your CEO was talking about all kinds of financial products they were going to roll out, checking accounts, savings accounts. They had just landed Apple as a credit card partner, which is, for a first credit card partner, was a pretty big get. About a year later, they kind of pivoted and said, no, the credit card partnership's actually not working out well. We're losing money. Marcus, the lending business, is losing money. And so they pretty much exited the personal finance space in late 2022, early 2023. So in 2023, it was trading for well above book value. I saw some better opportunities in the space. So I sold the stock. It's up about 50% since I sold it. So did I make the right decision? Who knows? But Dan just recently bought Goldman Sachs, and we're both big fans of the banking industry. But Dan, give us kind of a rundown of what your mindset was when you hit the buy button on this one.
Yeah, so it's fascinating that you bring up in those terms, Matt, because so much of what I like about Goldman Sachs, it really focuses on the other side of its business, on its investment banking business. It's just, I don't think that anybody on Wall Street would argue that Goldman has a reputation for being savvy, for being ahead of the game in terms of innovation, in terms of capitalizing on popular trends on Wall Street, on finding financial instruments that can profit no matter what happens in the market, no matter which direction it goes. Goldman has the expertise to be able to find an angle that's going to work, pitch it to its clients, gather capital to implement whatever strategy they decide is best, and then find ways to profit from it. And so I was always kind of like, well, Marcus is great and maybe it's going to work, but maybe bring in some incremental stuff. But I was also kind of concerned that you don't really want to water down the Goldman brand. Well, Goldman has some panache among Wall Street. It's like, if you're a Goldman client, that means something. And so having millions of people being able to claim it, yeah, sure. I think that one reason you do the Marcus brand is to distance the Goldman Sachs name. Yeah, sure. All those Marcus customers could feel like they were part of Goldman Sachs, but all the Goldman Sachs customers could say, well, they're on the consumer side. They're not private banking clients. They're not investment banking clients. And so that, to me, it's like that whole episode was not a bad thing. In my view, it was kind of a good thing. It brought Goldman back to its roots, got it more to focus on that side of the business. And so much of, I think one of the reasons why the consumer banking looked like a good idea was that we were going through a time where the investment banking side of the business was having some challenges. The markets were up and down. There was a lot of dislocation. Companies didn't know whether to come public or not. Now the environment's a lot better. And I think especially with the Federal Reserve now starting to look at lowering interest rates, the environment on pretty much all sides of the investment side, whether it's fixed income, whether it's equity, I think that we're going to start to see some of the logjam break and see that side of Goldman's business work really well. For me, it's more the brand value than anything else.
Yeah, and you brought up a really interesting point that Goldman, they figure out how to make money in any environment. 2021 excluded, like you said, there was the SPAC boom and they were getting, investment advisory or, M&A advisory fees from, all these no-name blank check companies. Excluding that year, the financial crisis years, 2008. was actually one of Goldman's best years ever. They figured out how to make a lot of money. They make a lot of money from volatility. They're trading volumes off the charts. So if a recession were to hit, Goldman might be the best bank stock to own. But in the consumer banking stuff, yes, you make a really good point that, yes, you can make the argument that it devalues the brand. If I'm a client with $50 million at Goldman Sachs and now anybody can just go and open a product under the Goldman Sachs name, it doesn't devalue the brand. But I thought there were some kind of financial product layups that they just totally whiffed on. The credit card business, like how do you become Apple's credit card partner and not make money? Why not issue a Goldman Sachs branded credit card that's like a premium product like the Amex Platinum or something to that effect? There were a lot of different ways they could have taken it. They mentioned insurance products. Like Goldman Sachs Insurance sounds pretty impressive, whether you're a $50 million client or just someone shopping for property casualty insurance. There were a lot of different ways they could have taken it. I was kind of disappointed when they abandoned it. I get it; they're the best in what they do in investment banking. But just like I said, they were really going all in on consumer banking, especially when David Solomon took over as CEO. That was kind of his thing. It was just all in on consumer banking. And it wasn't just that they failed at consumer banking. It's that they fumbled the ball on something they were so into. Whatever it was, whether they were going to, try to build out grow the trading desk or whatever. If they fumbled the ball on anything like that, it would be kind of a disappointing, just kind of lack of execution. And I don't know, they're supposed to be the smartest guys on Wall Street, and you can't make money off the Apple credit card. It rubbed me the wrong way.
Yeah, I can totally understand that. At the same time, I think I give Goldman a little bit of credit for once they realized that it wasn't going to pay off the way that they thought it was going to pay off. It does take some guts to pull the plug relatively early, especially as you point out, they put plenty of resources into it. They made a big splash. They bragged about, just about every bank in the world would have loved to have a partnership with Apple. And so for them to be able to pull that off, it was a big deal, and they rightly pointed out how big a deal it was. But I have to assume that what they saw internally was not matching up with everything that they had wanted it to be, whether that is just that the consumer business itself wasn't doing what they expected it to do, or whether it was a drain on other areas that they wanted to pursue. It was too much of a distraction. Whatever the cause, didn't really detract from me the core reason why I like Goldman. That's why I've picked it for a long-term buy at this point.
It's fair enough. And I mean, the stock's trading at 12 times forward earnings. You can't make the case that it's too expensive right now. And like I said, it's got that kind of built-in recession protection that it benefits from volatility too. So good discussion. It's not a bad, I don't think anyone would go wrong buying it today. Like I said, the thesis was kind of busted for me. I bought other bank stocks with the money I bought at Truist Financial is what I rolled the money into. So I didn't make a bad move. But it's really an important point that there are a bunch of different reasons to sell and buy, and they can be equally valid for two different people. So thanks for joining me. I hope a lot of people learned from this discussion. Leave me some questions on YouTube. I know this is my channel, but if you have any questions for Dan, I'll be happy to pass them along to him and try to get you an answer. So thanks for watching. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.